Good morning, good afternoon, good evening. Welcome to join our part two. I actually see some familiar names. It's always good to have returned customers. That's a good sign. So let's give, we're half an hour now, but let's just give 1 or 2 minutes. I see people still trickling in the waiting room, and then we can get started. Okay. So while we are waiting, same as last time, if you can put in the chat where you're dialing from. And I'm not asking again, how many webinars on stablecoin you have joined so far. But yeah, just feel free to let us know where you're joining. And I see a couple of people who have actually had questions last time, but may not be able to open the mic. But again, we have a participant muted during the panel discussion, the first part of the webinar. But we'll promise to have open mic, and then also feel free to put questions in the chat while we're discussing with the panel. And then the second part will for sure have 25 minutes of Q&A. And so the participants are welcome to turn on the mic to ask questions, or we'll go through the chat and answer some of the questions from the chat as well. All right. So I see we're 2 minutes past, so let's respect everybody's time and get started. And again, for those of you who joined us last time, we're the CGAP team, and we're a think tank attached to the World Bank, focused on financial inclusion. And I lead up the policy team at CGAP. I also have my colleagues, Sonia, Mehmet, and Ivo joining me today. And we have a distinguished panel, but let me first talk about, spend a few minutes talk about what we are going to discuss today, and also have a quick introduction of our panel. And so you see from the title is called From Hype to Impact, what the stablecoin mean for financial inclusion. In part one, we actually start from some of the use cases of stablecoin for financial inclusion, and is particularly focused on the use cases of cross-border payments. And we also touched upon some of the policy questions, right, in terms of both opportunities and the challenges in terms of scaling up, and as well as risks from a regulatory perspective. And today we have a distinguished panel, so we can deep dive some of those policy issues. So we have Dante Disparte, who's the Chief Strategy Officer and Head of Global Policy and Operations at Circle. Circle, as you all know, is the issuer of USDC, largest regulatory stablecoin and the largest stablecoin by transaction volume. And in his role, Dante leads the global growth and the regulatory strategy, public policy, market expansion, international operations, and communications. And Dante brings decades of experience working in complex global financial risk issues. He is also a board director of the Atlantic Council, member of the Bretton Woods community, and a life member of the Council on Foreign Relations. And we have a Dorothee Delort, senior financial sector specialist in the payment system development group of the finance global practice at the World Bank. As I mentioned, we also, since we're an independent think tank attached to the World Bank, we have had close collaborations with our sister department at the World Bank. So welcome, Dorothee. And Dorothee works on national payment system reform, financial market infrastructure, digitalization of payments, fintech, and innovation. And she also participates in several working groups of standard setting bodies, CPMI, and the Financial Stability Board. And before joining the World Bank, Dorothee has extensive experience in central banking. And we have Efayomi Carr, partner with Flourish Venture. He brings extensive experience in entrepreneurship, social impact, and finance to his role at Flourish with a focus on investment in Africa. Before Flourish, Efayomi worked on both sides of startup and venture investing with several institutions. And I'm sure later he would also tell us a little bit about his experience in his first investment in blockchain-based payments in Africa. And then we have Luke Tuttle, who's Chief Product and Technology Officer at MoneyGram. He leads the team responsible for building and enhancing product and technology, driving cross-functional collaboration to deliver exceptional customer experience. Luke has over 20 years of experience at the intersection of fintech, edtech, and commerce. Previously also held engineering leadership and architectural roles at industry giants such as Klarna, Experian, and eBay, among other leadership positions across various institutions. So let me stop here with the introduction. And again, as we go on with the discussion with our panel, please feel free to put in the chat any questions and the thoughts you might have, and we'll be able to have the second part. And we'll also have an open mic, so people feel free to turn on the mic and come in and ask questions as well. Now, I'm holding our panel for a little bit long, but before we turn to the panel discussion, I asked my colleague Sonia. Sonia, some of you already saw her in the part one of our discussion, is our digital assets expert. So she's gonna just spend a few minutes to give us a quick recap on very select issues we discussed in part three, starting from some of the use cases discussion and what are the players and the key elements before we go into the policy discussion. So with that, Sonia, turning over to you.
Thank you so much. Hi, everyone. Thanks for taking the time for this webinar. As Haocong mentioned, I would like to level set and to do a sort of memory refresh on what we discussed on part one of the webinar last December, and also to provide latest inputs on the CGAP's work on research. So briefly, what I would like to discuss is like three elements or three slides, just not to overwhelm this discussion. The first one is use cases. The second one is related to a workflow for cross-border remittances and corresponding banking. And the third one is the interaction within the different layers in the ecosystem. So let's go with the first one. The first one, we have here stablecoin use cases. What we try to frame here with existing research and with the research that we have done at CGAP also, it's what stablecoins are used for. You can see here different grades of adoption and usage, and that also shows the potential for stablecoins to enhance the current market infrastructure. So what stablecoins are used for? They have the potential to be used for moving money, storing value, investing and financing, and also for settlement layer. On the movement of money, we can see the movement of money, and this is going to be the focus for discussion today, mainly is person-to-person cross-border remittances. There are like more than 300 million people that send money globally, especially from Latin America, emerging markets, Asia, and Africa, to receive they receive money. So this comes from diasporas and consumers. So we also have on the business-to-business side corresponding banking alternatives, or the option to enhance the flow for corresponding banking, supplier and vendor payments, corporate payouts, and something that's like increasing in adoption is treasury transfer between subsidiaries because of the efficiency that the stablecoins provide. On the person to business, we have digital commerce and the ability to do checkout with the stablecoins or subscriptions, for example. On the business to person and business to employee, we have the big adoption on the gig workers and the economy, especially for cross borders and also for payroll. And on the government to payments and government to person and NGO to person, given the programmability of stablecoins, we have social benefits and humanitarian and disaster relief. Going to the second part on the store of value, we have seen adoption on highly inflation economies, the use of stable coins to hedge against inflation, and also for emergency savings and access to dollars to do digital USD savings, and also for SME working capital and short-term liquidity. Going a little bit on the usage of the investor, institutional, DeFi users, and fintechs, we see stablecoins being used for investment and financing. How? On the business to business, for collateralized lending, borrowing, yield, and tokenized real world assets. What we see is tokenized real world assets, but the stablecoins with the ability to be used for the transaction leg, and a stablecoin denominated credit. We also are seeing supply chain finance. And last but not least is the settlement layer, the ability to settle at the institutional level with tokenized asset settlement. And when we have the asset on chain, the ability to do DVP and PVP, meaning delivery versus payments and payment versus payments. And also the ability to use this for institutional settlement and fund subscription. Going to the next slide, what we have here is, without wanting to get into the details, we wanted to show cross-border flow. We mentioned it previously that one of the use cases, for example, is to present alternative and improve efficiencies for corresponding banking. So what we wanted to show you here is a flow between corresponding banking versus a stablecoin enable. The actors are the same. What the stablecoin does, it doesn't remove banks. They reposition and improve the efficiency. And additionally, the settlement risk and the liquidity risk are decoupled. What we see on the traditional side, usually corresponding banking happens in T+1 or T+2 within the banking hours. Sender sends money, this goes to the sender's banks, and there is a process that happens with different actors, correspondent banks, international clearing or SWIFT, the national switch and clearing, until this gets into the recipient's bank and finally to the recipient, with all the controls and checks related to KYC, clearing, and settlement, and especially the Nostro and the Vostro accounts, which doesn't provide efficiency from a settlement and liquidity point of view. In contrast, what we have here is the use of a stablecoin for settlement. You see the same actors, the checks and controls haven't changed either. The idea is that they are going to be enhanced. And what happens is fiat is moved through mint and burned to stable coins. They are sent through the DLT, and then they are converted and get into the recipient banks. So that's the idea of using behind the scenes settlement as stable coins to improve settlement efficiency. And now what we would like to show you here is what the CGAP has been doing in identifying how these different layers move at the architectural level. We have discussed about stablecoins, the use of stablecoins and blockchain to improve settlements and to increase efficiencies, but also this has an interaction at the user level. So the user can access to these services via wallets and applications. They provide the user interface and the user experience via custodial and non-custodial wallets. And to access to these services, the user has to go through customer due diligence, customer KYC, through like verified credentials. So that's the layer that corresponds to the user access. Going to the bottom layer, this is what we've discussed, and this is the core of this webinar, the core transaction and settlement layer using blockchain protocols and also stablecoin treasuries. There is a process in which we mint, burn, and redeem those stable coins. And if the ability to do programmability exists, we also are talking about the smart contract layer. And in between this sandwich on the interaction with the user and what's behind the scenes, we have the elements related to orchestrating that cross-border transfer through APIs, and also the elements that are mandatory when we provide financial services related to risk compliance and on and off ramping. Because from a user point of view, in many cases, users still need to use cash. That might evolve, but this is where we have the on and off ramping. Let me stop there and pass this on to Haocong. Thank you.
Thank you so much, Sonia. So basically, what we've just been through is looking at some of the pain points of the traditional system and to say what use cases we have for stablecoin. And then we talk about, some of the gains, efficiency gains or cost reduction in terms of, both liquidity management, settlement, user experience, and risk management aspects. And then we'll go into the ecosystem, the orchestration layers. And then now we are ready to move in terms of the policy implications and also the some of the regulatory considerations to realize the potential while also managing risks. But let me first start with you, Efayomi. For us, holding U.S. dollar hard currency accounts have means of different savings investment account, and then day-to-day transaction relatively smooth, right? It's hard to get a good sense of stablecoin adoption in countries such as Nigeria or Kenya. Could you give us a little bit of sense of adoption in Africa, for example, who are holding stablecoins for what purpose, whether it's for store of value or for day-to-day transactions? Do they actually pay merchants using stablecoins? And what's the scale of adoption, if you can give us, some sense?
Yeah, no, thank you. First, thanks for having me, and I'm really excited to discuss this topic because, as you mentioned, there is lots of relevance in these markets today. I think, it's important to note that today stablecoins in emerging markets, they're not a speculative asset, but they are a practical response to things like inflation, things like FX scarcity, unreliable banking access, and more specifically, like costly cross-border rails. And so, in an African context, adoption is uneven, but it's functionally meaningful. And I think it's for good reason that adoption in emerging markets and certainly in places like Nigeria and Kenya are higher than they are in more developed markets. I'll use Nigeria and Kenya as concrete examples since you pointed those out. I'm here in Nairobi at the moment. In Nigeria, stable coin adoption really first took off as a store of value due to persistent naira depreciation and FX controls. Many Nigerians were not able to access dollars because there's strict guardrails from the CBN or the central bank. And many of them were eager to store a currency in dollars, which would not depreciate. They were also used for cross-border transactions. So Nigeria has a large freelance and remote economy of workers who are working for companies or for use cases abroad. And so for many of these users, it was also very useful to be paid in stablecoins, which would be easier for them to access than dollars. And so for many of the usage in Nigeria, it's actually sort of off-chain economically, but on-chain technically. They're doing real-world services, but getting paid in stablecoins and dollars. In Kenya, it's a slightly different profile. So it's less about inflation hedging. Kenya, at least for the last 18 months or so, has had a relatively stable currency, but it's more about cross-border utility. So Kenya has a very strong mobile money profile. M-Pesa has over 98% adoption here. But stablecoins show up when individuals are receiving international income. There's a huge NGO economy here. It's a lot of contractors, freelancers, et cetera. Or for sending value regionally or globally outside of the correspondent banking system, which can be very costly, but also inaccessible for many users. So in Kenya, stablecoins are a complement to the existing mobile money ecosystem. And so maybe the takeaway here is that in many of these markets, stablecoins behave less like an asset class, but more like financial plumbing. They fill in gaps where banks, FX markets, or payment rails break down.
Well, thank you so much. This is really give us a very good sense in terms of the needs and the actual adoption in some of the emerging market and developing economies, as we say. And I really like the line in terms of off-chain economics and the on-chain technology part of the framing and the plumbing and the stablecoin as a plumbing. I'm sure we'll come back to these points later in our panel too. And Dante, maybe let me now turn over to you. So we talk about the cross-border payments. Will cross-border payments work really like as smooth as email very soon, right? And speaking of this frictionless user experience and also lower cost, and where do we see us going? And what does it take to get us there to this frictionless vision?
Yeah, well, first, it's great to be here with everyone today. And Sonia and CGAP colleagues have delivered a masterclass with not only the presentations, but obviously the great panel that we have assembled this morning. So, yes, I am guilty of having said in public many a time that in the context of stablecoins, the use of the word cross-border payment seems quaint. And I, until today, will continue to defend that point, mainly because the analogy in stablecoin money movement really till today, and Efayomi really described it very powerfully from the African context, is the same way you and I might experience email, in that, ignoring spam and ignoring all of the unwanted messages you might receive. We don't describe email as a cross-border messaging phenomenon. Instead, it's a messaging phenomenon where you get to send an instant message to a trusted recipient or a trusted counterpart. And the proliferation of stablecoins in many respects has really three pillars to it. I think perfectly described in the presentation, but the store of value pillar is a money at rest category where end users are using dollar-denominated stablecoins as a hedge against hypervolatility or other issues in the domestic currency setting. Even in prior years, we have now produced 4 consecutive years of studies looking at USDC and what we have historically called the USDC economy, partly to shine a light on use cases for stablecoins outside of digital asset trading or crypto markets, where you could, perhaps dismiss the innovation as a poker chip in a crypto casino. But when you look at it as always on financial infrastructure, plumbing, or even access again to the largely US dollars or the lion's share of stablecoin circulation, it's hard to, you cannot ignore the core pillars of this innovation. Store of value is money at rest. And then the money in motion pillar is, of course, where the cross-border payments market comes into play. But there, increasingly, the end user experience of stablecoin money movement analogizes very perfectly to the way we experience instant messaging, the way we experience sending emails. And so that notion of instantaneity, settlement, trust are all core pillars in no small measure, because the technology maturation is now reaching a point in time where you could anticipate Visa scale transaction throughput and fintech like or e-money banking and e-banking like experiences at the wallet level. The most critical piece of infrastructure in this entire conversation is actually blockchain rails and open source mobile wallet, which have enabled any basic internet connected device anywhere in the world to become a compliant payment endpoint. And so in that vein, the rails matter as much, if not more, than the cryptographic tokenized forms of money. And so in that sense, I will continue to defend the notion that a stablecoin payment in a cross-border context is like sending an email. Now, obviously, you don't want to strand people in stablecoin money if the stablecoin money isn't interoperable locally. And this is where I'm very encouraged to see more and more fintech entrepreneurs and startups start to actually take advantage of the fact that most of the value chain in digital assets is open source, and not just be the beneficiaries of low cost payments, but actually to be the builders of, in many cases, unicorn companies in their own markets and in their own jurisdictions. And I think in the end game, what you'll find is that the biggest winners and losers of the rise of stablecoins will not be the central banks or the regulators or the policymakers or even, frankly, the banks. It's actually the costly intermediaries who historically exact the highest cost on even the most important money flows in the world, and remittances being chief among them. But they do so with a hurry up and wait or a death by a thousand cuts proposition. And so if stablecoin money rises up, and it is interoperable, and you can promote FX and you can promote on-chain settlement of these cross-border transactions, and then lastly, build last-mile use cases where they can be fully fungible in the local economy, then you've now solved for, I think, one of the perennial challenges we have had historically in the development context, which is if the first of the sustainable development goals is to eradicate extreme poverty, I don't know how we're going to do that if we keep relying on the same antiquated systems and the same antiquated economic model to do so. And then all of the other SDGs that relate to financial access, financial inclusion, and lowering cost can now be achievable if, again, if you could render very, very fast, low-cost payments in a trusted manner at world scale. And I think a lot of this architecture enables us to do that.
Excellent. And of course, you have many good insights there. I pick up 2 points very, very close to our heart and very appealing, of course, from financial inclusion point of view. One is this compliant endpoint. You mentioned that the other, of course, is the last mile aspect, right? But you also mentioned a very important point, which is interoperability. And there's many layers in terms of, the chains, the technology, the assets itself. And then you also mentioned the interoperability locally, right? In terms of both of wallet itself, but then also the part where do you need to off ramp or do you need to spend the stablecoin somewhere, et cetera, et cetera. I'm sure we'll come back to this point of interoperability, and then I'll also ask your views and others' views in terms of fragmentation risks later. But let me now move to Dorothee. The World Bank is involved in a lot of these cross-border payments discussions in terms of, and also including the G20 discussion on enhancing cross-border payments, the G20 roadmap. And you're also sitting on quite a few working groups with the standard-setting bodies. And I'll throw out a big question, and of course, we'll have the opportunity to unpack, right? But where do you see opportunities and the challenges in terms of the scaling, the user experience, etc., and also the risks in stablecoin adoption? And then I'll also add a question about a lot of these discussions. For example, we discussed major jurisdictions, MiCA, Genius, and the UK is doing consultation, and then you have Hong Kong, Singapore, and various other major jurisdictions. But from the developing country and emerging economy perspectives, where do you see the key questions, right, in terms of regulatory gaps and how the World Bank would advise the EMD authorities to approach these issues?
Thank you very much, Haocong, and very nice to be part of this exciting discussion. First, I would like to take a step back, and we should not forget that we've seen amazing innovation in the space of payments over the last 10 years that have led to critical gains in financial inclusion. And it's very much been the case that emerging economies have been on the forefront. From e-money in Kenya to fast payment system in India with UPI, we've seen that innovation has led to this fantastic progress in the speed and the accessibility of payment services in emerging economy. And the World Bank have been supporting this in order to enable this safe and efficient payments rail in emerging economy, and has led to really leapfrogging on payments. So innovation in emerging economies in payments has been happening for a while now, and we've seen amazing progress. Where the progress have been lagging is definitely on cross-border payments. And I want to come back to what Efayomi and Sonia said, because this is something the World Bank is actively working on. We strongly believe that safe, inexpensive, fast, and transparent cross-border payments are critical for developments. Why? Because they are, I mean, for example, in the case of remittances are estimated to be $900 billion for 2024. And there are more than 12 countries where remittances account for more than 20% of GDP. So cross-border payments broadly represent a critical pathway for integration in the global economy, especially for small and medium enterprise. Like was mentioned before, we know that freelance workers now account for roughly 1 in 10 consumers making or receiving cross-border payments. So in this context, also where account ownership increased in emerging economy because of the progress I mentioned on payments, more than 50% over the last decade, between 2011 and 2024, according to Findex, we see that more individuals and business need to gain access to digital cross-border payment services. And when I say we're not there yet, it's because the average cost of sending remittances is still at 6.5%, which is more than double the UN SDG target of 3%. We've seen progress. Let's not forget that. The proportion of corridors with average cost of less than 5% has increased from 17% to 84% in 2025. So we've seen progress, but we know that there are still a lot of very costly corridors. At least 6 corridors in sub-Saharan Africa have still cost above 20%, which is unacceptable. And in many countries in Latin America and the Caribbean and in sub-Saharan Africa, MSMEs face costs that are still too high. So that's why we're very excited about global stablecoins. They've emerged from private sector innovation as a potential alternative rail for cross-border transaction. And while, as Dante mentioned, they've usually been seen as a gateway to the crypto ecosystem, we want to follow very closely their real-world application, like Efayomi mentioned. And honestly, I wish I could say that it would be as easy to send a cross-border payment as it is to send an email. But there are very substantive difference between sending an email and sending money. And we should not downplay this AML CFT friction, this balance of payment friction, this capital flow management friction, because if we do downplay them, we will not achieve the gains that we're all looking for. So this is why EMDEs have to walk a tightrope between allowing innovation and meeting this very legitimate demand for access to faster, cheaper global payments, but at the same time, safeguarding the financial and monetary system. Because, I mean, Efayomi said it very well, most stablecoins used in emerging economies are foreign denominated stablecoins. where issuers are not located in the country. So this is creating additional challenges for regulators on how do you properly fulfill your mandate as a regulator to make sure that you protect the financial stability of your financial sector and do you protect your consumers. I mean, if you push the analogy of email, we know that email is also a conduit for fraud. I mean, we've all seen this phishing email, and with innovation, with faster payment, we've seen an increase in fraud. So we have to take that into account, and with financial stability, monetary sovereignty, consumer protection should be a priority for regulators in EMDs. So this raises a lot of questions, and I feel very strongly that our role, all of this in this panel, we as the World Bank, but also stakeholders from the private sectors that have very good knowledge of stablecoin, we need to help EMDs regulators understand how they can answer some of the key policy questions they are faced with. And these policy questions are, should I allow foreign currency stablecoins as a mean of payment within my country beyond cross-border payments? How do I deal with the risk of disintermediation for my domestic bank? How can I make sure that if deposit move very strongly to stablecoin, my domestic banks will still be in a position to extend credit to MSMEs? How do I make sure that I will still be in a position to have effective monetary policy if most of the deposit in my country are on a foreign currency denominated stablecoin? So we have international standards from the Financial Stability Board, from IOSCO, and they've been very helpful in helping designing this regulation for stablecoin, but we still see that many EMDs are still at the very beginning of the regulatory journey. There are very few EMDs that have a comprehensive regulatory framework for stablecoin, in part because it's still not clear how they will deal with the main adoption, which is adoption of foreign denominated stablecoin in their country. So I'm very excited to discuss all of these questions with you today.
Dorothee, thank you so much. I think you brought out the excitement and also striking a sobering tone in terms of, there's various other policy issues really we're grappling with, and a lot of those I don't know whether how much of it will come out with definite answers today. But I think, we need to continue to have this policy discussion and the debate, right, for us to get somewhere where we can collectively, both the private sector and the public sector, to offer good insights and policy advice, in particular from EMD point of view. Thank you very much. I'm sure, in the first round, I tried to throw out all the big questions. You did come to, the AML financial integrity point of view, the financial stability point of view, credit intermediation, disintermediation, monetary sovereignty, and the financial consumer protections. We will park these and we'll unpack in the second round. We have plenty of time to do that as well. But let me turn to Luke, who has been very patient. So the last big questions I also want to throw out. I actually have a very long-winded question in mind for you, but let me try to simplify, right? what I wanted to ask is really how do you see as a major international monetary transfer operator in the ecosystem, how do you see the dynamic, the competitive dynamics shaping up, right? And the what I'm trying to get at, in addition to the competitive landscape, all the ecosystem players in it, the key question is what's the potential for value creation as well as whether consumers in the end will share in the benefits, right? In terms of smoother user experience, lower cost, speed, efficiency, et cetera, et cetera. And then, and of course, I want to, in particular, hear your views in terms of, for example, remittances, right? Have we seen costs coming down across different corridors? What are the progress and how you see the outlook going forward?
Great, thank you. And it's a pleasure to be here, and thank you to the audience for joining us for this hour. But I'm glad I came last because I would like to say I agree with all of the panelists, but I also have a slightly different view, being one of the largest MTOs on the globe. And I would like to point out kind of at the start is, MoneyGram and some of our competitors have hit that 3% goal, and we've been there for a few years. That there are unequal services around the world. There's many niche players, a variety of reasons why money transfer might be at that 6.5%. But many of us do provide a service that is quite cost efficient for the customers in a way that they understand what the fees are. And the reality is, as Dorothee said, there are regulations, there's monetary policy, and those need to be monitored and enforced, maybe might be the right word there. So even if you can send something with the ease of email, and I would argue we can almost do that today, or we do that today, and that most of our transfers globally happen instantly. But for that to happen instantly, we need to have a fair amount of money that we are able to move around the globe and be staged so that when a customer in the United States, for example, is sending to a loved one in Nigeria or Mexico, that the person can, on the receiving side, can pick that cash up within minutes for a relatively low cost, and also have that pickup of money be governed by the controls that are in place in the governments on the sending and receiving side, or the regulators that we work with on the sending and receiving side. So that being said, we see stablecoin as being a very important component in improving our business. And it does require an ecosystem approach. And that, as I mentioned, we're taking money, I always mention, kind of on the left side, taking cash in through our partners. They need to settle to us. And on the other side, we're pre-staging money so that we can pay out quickly, whether it's in cash to a wallet, but those are fiat. So there has to be real money sitting somewhere to be able to put into that consumer's account or wallet that they're able to spend immediately in the fiat system. So stablecoin can help us more efficiently move that money with our partners on a more real-time basis, or in a way that we're balancing the left and the right. We're also providing a non-custodial wallet to our customers. We announced that being launched in Colombia a couple months ago, and we've been a long-standing partner of Stellar as a blockchain company whose one of their main use cases has been on international money transfer type flows. Many articles they've written on, particularly the aid case that we've contributed in supplying technology to disperse those funds. So from a competitive standpoint, we see it as a business imperative that we adopt stablecoin to become increasingly efficient in how we manage money, but also to provide new services to our customers. One example for that, and I would say provide service to our company on a global basis. So many companies today providing tools for financial inclusion are based on the existing bank accounts. One of the real benefits of the non-custodial wallet is the ability to have a financial infrastructure that can work in every country on the globe, of course, subject to local policy. So that's our direction. And then in the United States, we have an example with the 1% federal remittance tax that went into effect on January 1st, that customers who transact in cash are subject to that tax. So if you're sending from the United States to Mexico and you've brought cash to an agent, then you're subject to this 1% tax. However, if you use your debit card, you're not. So this is a common theme. It's been in place, I think, as far as I'm aware, that the folks who are least privileged generally shoulder the majority of the burden of fees in our financial network. So by having a financial product that enables us to have more people access it, enables those customers, those individuals, those people to be subject to less fees because they're able to be participants in the financial network, financial economies, just as we are. Everybody else is who's able to get a bank account. So competitively, we believe that that's an important service that MoneyGram adds on to our network so that we're able to provide some additional endpoints so when money's being sent and received. So about 70% of our transactions are digital in nature. So there are many customers in, say, the Philippines, as an example, have GCash. So that has increased some of the inclusion there. But that's still fiat. You still got to move money, and stablecoin can help us be more efficient. So competitively, that's, as I said, extremely important for us to use stablecoin both on the consumer services side, as well as our own services within Treasury, FX trading, much lower fees, we believe, in doing those trades, as well as settling with our customers. Everyone's aware of the high cost, in many cases, of wire transfers, the time that takes. And the more money that's in flight, the more costs you have while that money's in flight. And we believe that stablecoin can lower some of our capital needs potentially, which has a very big impact on our cost structure. I know you're going to also ask me about transfer rules. Should I ease into that, or is that your second question?
I think we can leave the regulatory issues to the second part, but you do raise a very important point. For example, as a colleague of mine also used to say, it's still a cold fiat world. So you do mention, there's a balancing and also ramp. But I find it also interesting, in terms of this policy tension, right? As Dorothee mentioned, is a policy choice where you want to have leverage that efficiency gain and also the user experience, but the balancing with other financial stability, integrity, financial consumer protection aspect, for example, coming to non-custodial wallet, right? I'm sure we will come back to this issue also in the second part. Luke, I see you. Yeah.
And just add on that. So one thing that stablecoin does, it might change where some of the controls are implemented. So we have AML, CTF controls, as Dorothee mentioned, are exceptionally important to ensure both the safety and trust with our own customers, but also to implement these very important policies that are in force globally. But with stablecoin now, you could imagine going wallet to wallet. That's instantaneous. That's fantastic. And I do see a world, as Dante believes as well as me, that stablecoin and that wallet can now just be spent at the merchant, and the merchant can now go pay their suppliers using stablecoin. So that's the ecosystem play. But there still has to be points in the experience where the controls are implemented. So that might change the nature of where some of the fees lie. When does the FX happen? Like FX is a real thing. There's a point at which an FX conversion would happen. There's some cost to that, but that might change the balance of where some of that happens. But the technology and the implementation, this could certainly be part of smart contracts as well within the blockchain infrastructure. But there's many steps to get to that point where the proper controls can be put in place to ensure the compliance and the safety and security of our global money network. But we also think that just as every time someone uses a credit card, there's a merchant fee that the customer is not aware of. In many cases, the merchant is. They understand the cost to have card processing, an example. That may be possible to shift the fees so they're less on the customer. They might be more on other parts of the ecosystem in their usage. But there still needs to be a point somewhere in the chain, whether it's programmability, smart contracts, or through an organization such as ourselves that's able to implement those controls.
Excellent. Yeah, I think, now all these points are out of the gate. We have the smart contracts, talking about the compliance by design. And you mentioned it's not, you leverage that efficiency part, using the term we use like a stablecoin sandwich, right? But at some point, there's need to be compliance checkpoint, control points, et cetera, et cetera. And then in terms of the off-ramping, you could off-ramp, take out the cash. You could, in the future, if there's enough of a network effect and the adoption acceptance increases, you can spend them, right? And, with various other services attached to that wallet as well. So, I'm mindful of the time, and I'm just let's go into the regulatory and unpack some of these policy and the regulatory issues. I want to come back to this stablecoin regulation in the EMD context. And Dorothee, in the first round, you mentioned some of the big headline issues, right? But what are the key regulatory gaps? Are we making progress, or in terms of our policy advice to EMD authorities? And maybe I'll ask other panelists, and Dante put on your policy hat, and Efayomi and Luke as well, from the private sector point of view. And let's unpack the policy, the regulatory aspect a little bit, and then see where things stand and what are some of the big gaps we're still grappling with. Dorothee, maybe over to you first.
Yeah, thank you.
If you could do
also,
like a three minutes opening. I'm challenging.
So what we can say is that to date, very few EMDs have fully finalized framework for stablecoins. And this is including maybe Bahamas and Bermuda. Several EMDs are at various stages of developing a framework. I mean, we know that China, India, Indonesia, Mexico, South Africa, and Turkey, for example, currently have no framework in place, even though they're starting to develop a framework. And what we can see is that some of these countries have favored a kind of gradual approach to crypto regulation. The first step has usually been to regulate, to close the gap on the application of AML/CFT laws and regulation. This is usually the first step, and many countries that we see that want to regulate crypto and stablecoins, they want to do it in order to be in compliance with FATF, recommendation 16. So usually they start with closing the gap on the application of AML/CFT laws. Then they start looking at the requirement and condition for the use of stablecoin by crypto asset service providers. So they start by regulating or designing a regulatory framework for crypto asset or virtual asset service providers. And then comes the question of requirement and condition for the use of stable coins for domestic payment, always with the view of preserving the domestic currency role as the anchor of domestic payments. And these include establishing clear requirements on redemption rights, on reserve composition, prudential requirements. And these are very difficult questions. How do you set the prudential requirements for stablecoin issuers? You also have to take into account competition issues. In EMDs, especially in Africa, e-money issuers have been critical in enabling financial inclusion. They have a lot of requirements in terms of agent, in terms of onboarding of consumers that stablecoin issuers might not have. They have also, very often, they're not allowed to benefit from the remuneration of the trust account, while for stablecoin issuers, they might have ways to bypass this rule. So how do you create this level playing field between these various providers is a very important question. And then the third aspect, the third dimension is protecting consumers from fraud and abuse. I mean, I mentioned fraud in fast payment system. We've seen also fraud and abuse in the crypto ecosystem. So how do you implement this rule, especially in a context where the issuers of the stablecoin might not be licensed and in your own country? So if you want to, so what we see today as the World Bank, and we're supporting many developing countries in answering or design this question about how to regulate beyond the FSB recommendation for global stablecoin, beyond the IOSCO. There are very practical questions on how to that still require, for which EMDs regulators still require a lot of guidance. There still are a lot of open questions that needs to be discussed. And I'm not even going into the issue of insolvency and resolution risk, risk of, I mentioned regulatory arbitrage, and again, in this context of increased difficulty to enforce rules and obligation on foreign providers. So I'll stop here for now.
Oh, a quick reflection, in on top of my mind, really, we have the issues in terms of importance, like monetary sovereignty is very important, but then there's also other issue might be more urgent practically, like you mentioned that, countries might start from closing the AML CFT gaps, right? Because once you apply, it's immediately relevant. Well, in terms of adoption, if you worry about dollarization, first of all, you start with already widespread dollarization in many of the EMDs, and then whether stablecoin really change that picture, in what time horizon, and then the scale of impact, whether it's immediate or not, right? So I think we're grappling a lot of issues in terms of practical implications, like you said, beyond the standard setting bodies guidance, right? In really practical issues from EMD's point of view, and then also, some urgency versus practical importance to have a framework in place as of now, right? So we will come back. Hopefully, I also want to leave audience a little bit of time to talk about, to ask questions. And you did mention travel rule and AML CFT. Why don't we go there? I'm looking at Dante and Luke in particular, right? So what are the current solutions available from your point of view? And it's already a lot of use cases in practice, right? How are these issues being adopted? I really saw a lot of from service providers saying, this is a built-in and travel rule compliance. How does it work, and what is the picture, and do you see any gaps? And then the other side, of course, is everything on chain, right? What about the privacy issues at the same time? And by the way, we're also gonna come to because when I see scale adoption, it's not point by point control, right? You're at some future stage, we'll need to talk about digital identity verifiable credentials where, users can hold in the wallet and then selective disclosure. So I'm throwing a bunch of issues now, but it's mostly about the AML issues. What do you see as the current status quo and the outlook where we're going? Whoever wants to come in first.
I can start on the travel rule, and I'd like to know what Dorothee was talking about, in that the policy is very by jurisdiction. So The conceptual nature of a non-custodial wallet is that it can kind of be freely used wherever, but the reality is that there's varying policies, which makes the global rollout complicated. But on the travel rule perspective is we do apply the principles travel rule today. There's a need to collect the person's name, account information, the amount, the date, the account number, etc. And as a reminder, this applies to wire transfer type transactions where the information is traveling between financial institutions. So very clearly we do apply these rules today. And one of the things where we've gone above the Financial Action Task Force travel rule is that we've been KYCing from zero for quite a long time. So we ensure that on both sides of our transactions that we understand who that person is with a know your customer identification. And we also took that decision to do that in the launch of our wallet in Colombia. So to have that in a custodial wallet, we go through the customer identification process with that KYC. So we know that endpoint, who is attached to it. And that enables us to have the ability to know, again, who's on both sides of the transaction. So the send thresholds don't matter because we took the business and compliance decision to get that information up front. And that's key to ensuring safety, right, in terms of the network and the customers that work with us as well. On the privacy side, we are stewards of our customers' data, as any institution should be, or any fintech or business that works with customers. That should be paramount in the service that they provide. But then we need to identify what is the data elements that are required to be shared to enable us to implement the policies that exist. So we only share what's absolutely necessary as part of ensuring the compliance around things like the travel rule. Whenever that information is shared, right, we're following all the standards with respect to how it's hashed or tokenized, and then also looking at just the retention policy. So having a very clear program on how to use customer data is paramount for any service that is providing a financial service, or in my opinion, any sort of service of any kind. That privacy and ownership of data is extremely critical as a core design of any system. So that is again a core principle of MoneyGrams as well. But through those two elements is how we view the travel rule. And again, for us, it really starts with that very clear understanding who the customer is, and then sharing only what's needed when it's needed to be shared, and also then monitoring any of our partners who are participating with us to ensure that they are handling our customers' data in the same way of secure and control that we have on their systems.
Okay. So Dante, can I turn over to you on this same questions about compliance in general? And then I also want to come back to the fragmentation, because what I hear Luke saying, in Colombia, we provide this so in this sort of a closed ecosystem, you can identify customers to say, I know both endpoints of the transaction. I know who hold my wallet, right? But in the broader ecosystem, how is this dealt with at the larger level? I'm also going back to the fragmentation point of view, right?
Yeah, I mean, obviously, there's a lot to respond to in the various rounds that we have had, and I realize we're up against a clock as well, so I'll try to be brief and substantive. The first comment I would make is to any emerging developing country listening in: watch what they do, not what they say. I think emerging and developing countries, particularly in the sub-Saharan African context, are the best places on the planet to be the proving grounds for what good looks like when you get these recipes right. And to simplify the value chain, stable coins are like e-money 2.0, and they don't exist in a vacuum. That part is super, super, super important. Number one. And by watch what they do, watch what they do, not what they say, I fundamentally mean as we look east to west, you almost have this de facto Belt and Road Initiative, for lack of a better analogy, in which major financial centers from east to west, and Dorothee described it, have regulated this product, right, at the stablecoin issuance and redemption level, and have created a level playing field in which all of the issues that will matter around AML, CFT, sanctions, prudential risk, liquidity risk, consumer protections have been broadly settled. It's now the legal basis in the United States with the Genius Act. It's the legal basis in Europe with MiCA. And you go around the planet and you can get from Singapore to Japan to Hong Kong, South Korea, imminently the United Kingdom. And so why not also ensure that North and South develop their policies and their regulatory platforms in a principled way versus a prescriptive way, such that the real opportunity here can be fully unlocked? Meta point number one. Point number two is back to the point that stablecoins don't exist in a vacuum. The very first neck to choke in a jurisdiction that wants to enable both the cross-border use case or the remittance use cases or the financial inclusion use cases that we've described so far is the virtual asset service provider. The last mile of stablecoin activity is fundamentally a wallet. And the more you have clear rules on how those wallets can interact with both the domestic and international markets and the banking system more generally, one really important point, crypto needs banks more than banks need crypto. And so without the ability to have on and off ramps into the core banking system, you might have monetary airline miles, you might have internet funny money, you might have digital loyalty points, but you won't have something that could plug into the real economy. And so this notion that everything in digital assets and in stablecoins has to be a risk-based conversation, I think is in some respects jeopardizing the opportunity. So much of the way we move money in the world is wanting for big improvements. And all we have shown in the emergence of blockchain-based financial services and stablecoins is that there's another way and another rail in which money can move. That doesn't necessarily have to jeopardize the underlying rules, but those rules need to be developed in lockstep. And we'd be very well served in promoting an opportunity-based, principle-based framework that emerging developing countries and others can gain from, beginning with regulating the virtual asset service providers and the wallets. I think that part is imminently easy. We have rules to do it. We could harmonize those rules. And if we do that, we could start driving down fundamental cost and increasing competition, as I think Luke rightly described.
Excellent. Really good insights. Let me now, I'm asking Sarah to already open the mic. Wendy, I'm looking at you. I'm just giving you a heads up because last time you were not able to open the mic. But I see a couple questions in the chat already. And one question definitely came up again, including in part one, right? It's a cost, whether we have really, corridor by corridor, we know what the cost of traditional channels, we know, right? The World Bank has a data platform for that. For stablecoin, do we know, right? And you say at some point we already have sub 3%, and a lot of people are telling me, they can go into with a stablecoin sandwich model, could go to sub 1%, right, in various corridors now. But do we know, right? And what is the fee structure in terms of, the sending cost, the FX spread, et cetera, right? I think we need more transparency there, just, asking for our audience. And then maybe, Efayomi, let me turn to you. In terms of Africa, you gave us real use cases, right? What does it look like? Sending $200 cross country in the African continent or with the other jurisdictions around the world. And then I want to again come back to the dollarization issue here, right? And how do you look at this, and what are the sentiment? I know there's always, because dollarization fundamentally is a macro issue, and people look at, my choice, what purpose am I for a store of value, like you compare Kenya and Nigeria, and then what are the yields, right? We haven't talked about yield, which is also a complicated issue, and for different purposes, and then macro risks fundamentally, right? So I don't think you can kill dollarization with regulatory administrative measures. So that's one. But I still want to put it to you. What is the sentiment you hear from the policymakers and then the overall environment policy debate in Africa about the dollarization issues? And if you can give us a sense about the real costs, even anecdotal. Over to you, Efa.
So maybe I'll try to quickly answer the question on dollarization, and then I'd love to hear perspectives from maybe Luke and Dorothee on the cost, because I actually think they might have more concrete data. I have some anecdotal data from our portfolio, but I'd be curious how they're seeing from a broader perspective. But maybe just quickly on dollarization, I think it's important to note that stablecoins are existing outside of the policy mechanism. I'll give a very quick example of Nigeria. 3 years ago, they had a big protest movement called EndSARS. One of the main methods for moving money was crypto and stablecoins. At the time, Nigeria had top 2 or 3 adoption globally. The government banned all use of cryptocurrency in the country, and adoption spiked, right? And what that showed was, one, that there's a true use case, there's true demand for this technology, and two, that this exists outside of a system that the government can regulate. There was a bunch of workarounds that were being used so that users and businesses could still access crypto. Now, what that's also created is a big trust gap between individuals. As was mentioned earlier, many of these markets are in the process of developing policy. And the reality is, as governments get involved in crypto, particularly in these low trust environments, individuals lose trust in the underlying product. Right now, it's actually, the trust is coming from the fact that governments aren't involved and that it exists outside of the system. Now, the reality that was alluded to earlier is that one of the key pillars of monetary policy, especially in these companies that are heavily input reliant, is control of FX and control of dollars. These countries have a huge reliance on being able to track and monitor the inflow and outflow of dollars to stabilize their currency and to conduct business. The growth of stablecoins makes that much more difficult, and that's why there's this huge move to create policy that allows these to be more closely monitored and integrated into the banking network. So the reality is that this is happening for true reasons. I know we're short on time, so I won't go into all of the various FASP and CAS bills that are sort of going through parliaments and state houses across the continent. But the reason that it's happening is because adoption is high, because businesses have really practical use cases. It's easier to pay suppliers, et cetera. And because users are finding strong ability to send and receive currency. I'm a venture investor, and so my job is to understand these trends. And I actually want to maybe just throw in some spicy hot takes as we're getting close to the end of time. I think what we're seeing and what a lot of folks are what we're starting to put a lot of our time and capital into is the degree to which there doesn't need to be a conversion into the fiat world in order for these use cases to be, in order for individuals to use crypto and use stablecoins. We've already seen last year the amount of companies, many of whom are on this call, who are starting to develop partnerships that allows users to spend and access stablecoins without having to transfer into the fiat economy. I think going forward, we're going to see more and more use cases develop as adoption increases. We'll see more yield-bearing use cases. We'll see more stablecoin asset management, and we'll see more opportunities to spend stablecoins in retail outlets, online, et cetera. In that world, where to Dante's previous point, where the end use is a VASP or a wallet as a means of transferring this money and making some use out of it, that actually creates a very different circumstance where individuals can fully transact in a parallel on-chain economy without needing to touch the traditional banking system. And so, I won't belabor this point, but I think the key takeaway here is that, one, governments have a vested interest in monitoring and tracking the use of stablecoins and all on-chain assets. Two, individuals and businesses, especially in these resilient emerging markets, have proven their ability to transact outside of the government ecosystem. And three, we're seeing more and more use cases that allow for real world use cases outside from an on-chain without having to convert into fiat or real world assets.
Excellent. Thank you so much. So I'll leave a moment for our speakers to come in. I did see a hand earlier. I would ask people, if you can raise your hand or just open the mic and come in. Not Manal. Sorry if I mispronounced your name. Please come in.
No, you pronounce it correct. Manal, Digital Financial Services Consultant. Actually, I wanted to build on what Dante and Efayomi mentioned. Someone who grew up in Africa and noticed this happening on our daily lives. The two use cases of international remittance and savings. Actually, they are happening outside the official channels, banking system. We save in dollar, money transfer happening through informal channels in a way very much similar to stable coins. You have these informal networks, they receive money in the sending country, they keep it there, and the recipient receive in the local currency. It's the same way how stable coins work. And now I keep wondering, yes, the start was with dollar, but now we see many countries, for example, United Arab Emirates, regulated stable coins, started issuing, and now it is used for retail payments, and soon will be used for international remittance. So for just focusing on Africa and looking at the diaspora map now, we have a lot of diaspora in Gulf region. We have many in US, many in Europe. So we are going not just those who use dollar, but we will have different currencies. So having stable coins issued in different currencies, that means the issue of the fear of dollarization for me, it will be less and less as the adoption of stable coins increases. And I don't know if at some point there will be like some sort of interoperability between different types of stable coins. When it comes to regulation, I am not a policy person, but for regulators, for governments, having very strong formal channels compared to have visibility over the savings and international remittance when using stable coins, how to reach an equilibrium point and balance point between realizing the benefits of visibility of economic benefits from stable coins versus the fear of other issues. Thank you very much.
Okay, thank you so much. Who wants to come in? Please.
Yeah, I can answer this question on interoperability. I mean, it exists today, but as with most types of transfers of money across currencies or the modalities of the money, there's fees. So on blockchain, there could be gas fees, and then there's also FX trading fees. And what we see in some cases is trading in stable coins is much more efficient. It can give you access to different liquidity pools where you can do those trades, but there can also be dramatic inefficiency. So as with any evolution, there's pluses and minuses. I think, strongly believe eventually that interoperability will become more efficient, more ubiquitous. But that certainly does exist today, and it will become more important as stablecoins proliferate in different currencies and different locations.
Can I come in, Haocong?
Sure. Yeah.
So, I want to come back on the issue of data. We really lack data. You mentioned the World Bank remittances worldwide price, RPW price worldwide database. And right now we don't have enough data. And this was also highlighted in the FSB report on, we don't have enough data to clearly monitor and evaluate adoption, but also to assess the impact of stablecoin on the cost of remittances. So we, the World Bank, we would like to collect more of this data in order to be able to assess the impact on stablecoin on the cost of remittances. We have to be mindful that there's also the question of economic sustainability. Providers need to make money. I mean, this is not me, that I will not teach that to Efayomi, that startup and fintech. They need to make money somewhere. So we need to be careful about the idea that all services can be rendered for free. I mean, of course, I'm a policy person. I would be happy to, but then how would the private sector make money? So we have to navigate again closely the issue of excess fees and the no fee at all. We have to, if we want a vibrant ecosystem where fintech and providers can grow and offer more services, we should not fall into a caricature of saying that everything has to be for free. This was one point. Another point is the question of interoperability. We want interoperability not only between providers on chain, but if there's no interoperability between with the traditional banking system, then you won't have, I mean, it's one thing to store value and save, but how do you access credit? And we've seen through open banking and open finance, new scoring models for people that may not have a bank account and that are using transaction as a way to build a credit history. So how do you make sure that you still have all the range of services that you need? And somehow they need to be interoperability between transaction history, between saving and credit. Otherwise, you won't have the financial health beyond financial access, the financial health that a lot of business and individuals are looking for. So how do we build this rule for interoperability, not only for provider on chain, but also with the traditional financial sector? These are some of the issues that we need to keep in mind. I'll stop here. Over to you, Haocong.
Excellent. I think, this point is very important for us to have a broader view. I think, we come with more and more clarity in terms of stablecoin as the plumbing or the real, it's definitely efficiency gain and value creation. And with the ecosystem, as people said, with different players, startups, fintechs that can add on the services and provide more and more use cases. But then at the same time, we also realize, financial services is a much broader manual, right? So we also need to have the certain balances. So in the end, we have the end point is where we see value. Wendy, I do want to give you a chance if you want to. I'm not meant to put you on the spot. And then any questions in the chat, I definitely see the question of cost already tackled to some degree, and then the need for more data. And whoever want to have more remaining questions will please come in, and I'll leave a couple of minutes to give our panelists the last thoughts to share with our audience.
I'd like to answer Wendy's question if that's all right.
Yes.
So
Okay.
Wendy was asking about where the FX will happen. So could it happen in different places with stablecoins and traditional FX, and does that pose different kinds of inflation risks? My perspective is that stablecoins, particularly in a wallet that the consumer holds, will allow the consumer to have more control and to also use their preferred ways of spending and saving. And I doubt the panelist group has any disagreement with me on this, and that and as a product leader, this is foundational to everything that I think about is what's the consumer's preference, what are the problems that they need to solve in their lives, and that they're ultimately in control and provided the information necessary to take good decisions. So today, when that FX happens, is largely out of the receiver's control. So the sender sends money and the receiver gets money. They don't have any opportunity to participate in that flow of money in most cases. So with stablecoin being able to actually hold that balance for saving, if it's US denominated, that could allow them to not be subject to some of those inflation risks. But they should also be able to convert it when they wish to either a local denominated stablecoin when they wish, or as noted, as things evolve, they could spend directly with it, with merchants who accept it. Fully believe that will happen at some point. But the core piece is that, yes, it can move where things happen, but does the consumer have a greater advantage because of their preference and control? And my belief to that is yes, that only good things can happen by distributing control to the consumer in how and when the money is used.
Okay. So thank you so much. I believe we tackled the questions in the chat. But let me now just very quickly, Dante, if I can turn over to you, and we'll go around whoever wants to come in next. Give us one-liner, last thoughts, or you have some points you particularly want to respond to.
Yeah, no, look, I mean, this was a fascinating discussion. Sadly, we don't have nearly enough time to go through the policy, regulatory, operating, and other market implications that were raised, but leave it to CGAP to have raised them in such a provocative and thought-provoking manner. All I would say is this, it's, just like a physical dollar, a digital one, its financial inclusion value chain doesn't exist in a vacuum. If you want to advance financial inclusion, you have to be very deliberate about it. And here, for the first time in a very long time, we have non-proprietary financial market infrastructure that could enable anyone, anywhere to at least introduce payment systems optionality, payment system competition, and in so doing, drive down cost and increase access. That's it. And we just have to accept that that is it, and that a lot of the infrastructure and technology we are describing is not monolithic any more than banking is monolithic. But what is also true is, how can we be so certain that if any of these things work, that all it will bring is risk? We keep describing the risk portfolio with certainty, but we don't describe the opportunity portfolio with any certainty. And I will challenge the group again to think in Ajay Banga's own words. He says, people are everywhere, but opportunity is not. And so I think if we rightly bend the arc of not just this technology that we're discussing today in the interest of humanity, then we'll figure out how to match opportunity with where the people are. And so I think that for me is the parting word. And if we could do that at scale with stablecoins and open infrastructure and open blockchains, great. Because the rest of status quo in the money movement discussion isn't looking great and is rife with risks of its own. But that's for another debate.
We really need a whole morning, at least, if not a whole day or more. But others, please.
Yeah, maybe I can follow in Dante's footsteps. I'm back from a couple of missions in countries where people are craving innovation, they're craving access, as Dante said, and the opportunities are not there yet. So we want to make sure that we enable and the benefits. But at the same time, we should not lose sight of the basics. These countries I'm coming from, access to electricity and ID is less than 20%. So it's all good and well, but we have also to make sure that people do have electricity, they have ID, so that then they can benefit from e-money and e-money 2.0, like Dante put it on. So we need to work on all those fronts without always losing sight of the goal, which is to enable access in a safe and efficient manner. And this is really the mission that we're working on at the World Bank.
I think that's a great summary, Dorothee. I wholeheartedly agree with everything that you said. And inclusion is definitely a long journey, and it starts with some of those basic building blocks. And we see this from the customer feedback that we have in the markets. As we've launched some of these products, that what I always love in product is the things that happen you don't expect. So as we've launched some of these products, the kind of questions that we get from consumers or interest in other markets has been quite strong, and that helps us better understand those consumer needs. But absolutely agree with you that the demand and the need is there, and it's great to hear that you're seeing the same thing.
Excellent.
And I guess I'll go last. Dorothee, I love what you said about never losing sight of the true objective here. I try to never lose sight of it. Behind me, my background is Freetown, Sierra Leone, where I'm from. And today, I can walk into a MoneyGram and send it through a MoneyGram agent, leverage the Circle network, and my family can receive money much quicker than they could yesterday. And it can be much, much cheaper, and they can buy basic goods. And so ultimately, we are excited here in Africa and globally in many of these emerging markets because, I think stablecoins thrive where trust in institutions is probably lowest, but need institutions to be included in order to scale safely. And so we're entering this new moment where access has now been in some ways democratized, and we're hoping to leverage that to build a more inclusive system more broadly. So it's an exciting time.
Okay. Thank you so much. This is a wonderful discussion, and I think the purpose is not for us to answer all the questions. I am sure if we have another webinar in 1 month, we have new answers and also new questions coming up. But I think I'm really glad where we landed. I see huge convergence among this panel from different perspectives, very nuanced discussion. I think I would just leave with one thing. For me, on top of my mind is a reminder of the humility in terms of all of us ecosystem players and policymakers and some of us doing policy research and advise policymakers really to monitor the technology and the market, have that curiosity and humility to start with. And then we lay out some of the policy issues that we're still grappling with. I think, this is one of those conversations, and I hope will continue. And maybe before we go, a little bit of commercial time, as I mentioned, we started with tokenization use cases. The reason being, is not only the plumbing, right? There's also other than the money lag, there's also other real world use cases. And we started with payments. We also talk about digital identity, verifiable credential, and the credit insurance, et cetera, et cetera. So this will be a series of research, and we'll have more webinars coming in. And even on the payments, one issue we haven't tackled is stablecoin as money and as settlement assets. And as you well know, that BIS and the central banks, IMF included, right, raise many issues about this money, the nature of money and the settlement asset and etc. So I want to mention in the more practical terms that there are alternatives out there. Stablecoin is what is really in use, right? But where we land in the future, I'm not sure. It's another conversation with our panelists next time, in terms of interlinking domestic payment systems, in terms of, CBDC and tokenized deposits to mimic the current two-tiered banking system. And then, of course, you have the yield assets, in terms of a tokenized money market funds, and then what are those being used, right? So I'm just throwing out, there are also alternatives that we can also look at, right? But I think we throw out more questions than answers in this webinar. But I think really our distinguished panel for this really insightful conversation, and I hope to continue. Thank you so much, everyone.